Wow. Ladies and gentlemen, welcome to Market Mavericks. I've taken 3 blood pressure pills. I'm not hyperventilating. I'm calm. And the reason why I'm calm is we have Katie Stockton with us, and she is alone, the lone person to lead us through this wilderness of WTF is going on. And Katie, it's great to have you on. The timing couldn't be better.
It's great to be here, Toby. Yeah, I know. It's been wild out there.
Well, I was, one of the things that really got me. So, also, what's great about this is I'm Mr. Fundamentalist and you're Ms. Technicals. So it's a very good fit. One of the things that really got me, Katie, was that going back to the research where whenever you have an extraordinary move like the 6-7% move in a day, that over the next 6 months, it's bearish. That you're going to it's happened. I'm looking at the number here, like 67% of the time. You retrace that crazy movement. Obviously, you don't have to be a market technician to understand that was the melt up of short covering last week, and there was only $81 billion lost by hedge funds that day too. So I'm assuming that you have a little guide path for us. You could drop us some breadcrumbs of where we go from here over the next, let's call it 2-4 weeks, whatever your time frame is.
Well, I would agree with you. When you do see volatility surge like that, as much as we all find ourselves looking for a short-term low, and indeed it does suggest that, it usually isn't the final low. It's not the cycle low that you get with that first spike up. In 2008, we saw obviously a massive spike in the VIX, and that ended up being a short-term low, but then the VIX kind of stayed above 50 for a long time.
Or did it?
And we didn't get out of it for a long time. So it feels to me like we have certainly a lot of evidence of a short-term sort of capitulative low, but that excitement should be limited to the short term, and that the long-term loss of momentum that we have in association with that increased volatility is the bigger issue, right? The bigger issue is that we have this bearish.
And I have a visual for you here. This is incredibly scientific. So I've been cutting out Barron's Magazine, New Highs and New Lows, literally before you were born. They actually sent it to me in a template, like, they typed it into stone. For the audience back there, last week there was 27 new highs in the NYSE, 1,475 lows. In the NASDAQ, there was 94 highs, 2,013 lows. Now, bad news is good news, right? That is the worst dispersion we've had, even going back to 2008, because first off, we didn't have that many stocks that were trading at that time, or maybe we had a lot more and they all kind of went. But that makes a difference, right? In other words, that would say we were washed out, except for the fact that we never had tariffs before. Again, unless you've been doing this for 70 years, which I feel like I have today.
I think so. We like to look at the weight of the evidence, right? So there's some measures that blew out to such extremes like that one, but then there's others, like we looked at today, the percentage of stocks above their 200-day moving averages on the NYSE, and it hit about 20% or dipped to that level, but bottoms have occurred much lower than that, right? Like in the single-digit percentages. So it doesn't mean you can't go lower. So the way we kind of approach those market internal measures, which is what I call them, things like sentiment and breadth and leadership being new highs, new lows.
Yes.
Well, we look at them in aggregate. So we look at a bunch of measures all at once, and we look to see how many are reaching extremes. If there's just one that's blowing out like crazy, it's interesting, but we're not going to take action or change our views. But if we have a whole collection, then we'll be more inclined to react to that.
Well, tell us about the Fairlead connection of horseshit numbers for the stock market, so we can see how wide and deep the breadth of this horrificness is.
Well, I actually can show you, if I open up my morning note. So every morning we publish the market internal measures that we find somewhat important. It's not a totally comprehensive list as to what we look at, but it's a good aggregated view of the market internals. And what we do, we highlight in green if they're collectively oversold, and we highlight in red if they're collectively overbought. And I will show you here.
Oh, that's interesting.
Yeah, and so it's
Well,
a little bit of a
I get
unique
your
way to
stuff, and
approach it.
I that's why you're my number one hero, because
I appreciate that.
you've been very, very on point
So
during this
here,
whole. Uh,
this is a tough time, but it's a good time to use just like the unemotional technical indicators, right?
no
So
question.
this is our market internals table, collection of breadth, sentiment, leadership, volumes. We're also looking at the spread between new highs and new lows. And yes, it's gotten crazy. But this one on April 8th, we had a very highly unusual number of oversold readings. So the takeaway certainly was for a short-term low around that level, or at that time, I should say. Now, it very quickly reversed, of course, the very next day, and that's sort of unusual. And yet we feel that it's still informational. It's like when we see one red reading, we don't that doesn't flag
Yeah.
anything to us, right? But it's when you get these collections. So we went back and said, well, when's the last time we had this many flashing green? And it was kind of interesting. It was on May, I don't remember the exact date, but May 12th-ish of 2022. So I went back and I said, well, that's kind of interesting. I don't remember that as an important date. And it was right around here.
That looks like my EKG from yesterday.
I can imagine it has been stressful. So here's the May low, right? And you can see how fleeting that was as a bounce. And it didn't bottom, the market didn't bottom, or the S&P didn't bottom until about October. So as much as it identified a short-term low, and you could argue, within a few weeks, ultimately an intermediate term low, it still wasn't near the end of the bear cycle. So I think we should get excited about the potential for a bigger relief rally, but we shouldn't get too hyper-focused on these market internals and rather focus back on momentum, price momentum, which is really what the most important takeaway is from the
Yeah,
chart.
I mean, obviously, going back to this time frame, this is when the yen carry trade blew up, which I had to explain to subscribers and to my wealth management clients, and they look me in the eye and they say, "Well, how is that possible, Toby? What is how did they borrow in yen and buy stocks, and then the yen went up, so they had to sell those stocks?" And I said, "That's what you pay me for, okay? We didn't, we all said kumbaya, and we knew it was a function of the market. It wasn't a function of the economy. It wasn't a function of earnings. It was a function." So that leads me to my next question, which is, we're now in this thing where the algorithms, and I know you keep track on this stuff, but I get a report on what percent of trades were algorithmic on the New York Stock Exchange,
Mm.
the American, and NASDAQ. OMG, that entire melt up was logarithmic. I mean, that was the highest rate I've ever seen, right?
Yeah, that's interesting, and I'd love to see the same data because I think it is hard to measure that, right? And it's almost the question is it real or not real? Is it short covering? Is it algos? If we get to the answer, it's probably over.
Yeah, right. Exactly. That's true.
So the relief rally is supported by those market internals. It's supported by the DeMark indicators, which I'm sure you know.
Yeah.
It's supported by the stochastics and the MACDs on the daily, but it's not supported by that on the monthly, as you can imagine. So the
And
monthly
you
is
use
quite
you
different.
use so I sort of use weekly as sort of the default just because I'm lazy, and I don't want to react to day-to-day stuff.
Mhm.
But you use the monthly. I'm interested in that.
We use that we kind of start with the monthly for our long-term bias. And, if you have the luxury to be a long-term investor, I would be that. We focus often very short-term in our research too, because we have demand for that. But the
Right.
long-term chart should be your sort of guiding principle in a way. So we feel like this monthly chart, which as you can see is quite clearly struggling with these downturns, that's going to set the tone for any analysis that is zoomed in, right? So we
Hey,
know
hey,
that we have sell signals
can
here.
I ask you, Katie? So what's the purple?
The purple is our cloud model. So it's got a Japanese name, something like Ichimoku. And
Uh-huh.
so it's a Japanese model based on midpoints of price, and it has this neat forward-looking element to it. So right now we're in this kind of flat zone, but you see how it resumes higher in 26. I think that gives a nice visual indication of the
Yeah.
secular uptrend is potentially resuming on the back of what we think is a bear cycle. So we're seeing, just like 22 is a bear cycle within the context of the secular uptrend defined by the purple.
Uh-huh.
And now we have these sell signals that tell us that we're probably in the earlier innings of this cycle, unfortunately.
You know, I think back to how the Japanese started doing charting, and it was for about rice prices, right?
Yeah,
Um,
in the 1800s.
yeah, I think they'd be very proud of your purple blob.
Yeah, and I use it probably a little bit differently than they did back then, but we find it very helpful as a gauge of support, resistance, and primary trend.
So is the blob, excuse me, is the purple blob, is it a combination of a whole bunch of stuff that, uh, comes
Yeah,
to
it's a
a,
little convoluted in the construction, but if you think about a MACD, which is like our most common technical indicator, the MACD is based on exponential moving averages of price. So everybody's comfortable with what a moving average is, and they're smoothed, right? They smooth the
sure,
price trends, whereas the jagged nature of the cloud comes from midpoints. So it's taking like high-low spreads and taking the midpoint and plotting that forward rather than a smoothed exponential moving average. So it has a little bit of a different quality. And then there's some calculations around that that gets you to where you have these two lines. But you could almost liken it to a very long-term MACD in a way, though, if you were to put it into its own window, it would have sort of a different character.
wow.
It treated this as an off period back here, but the secular bull trend has been intact for a long time.
Point okay. Well, I mean that's another issue that people are dealing with. Talk about being complacent for 24 months in a row. All you had to do is do nothing, and you made money, and you earned 25% a year, and everybody's fat, dumb, and happy. And then all of a sudden, speaking of fat, dumb, and unhappy, tariffs come in. It's all new to everybody.
Mhm.
Nobody's got an edge on this. And I just go back to the Smoot-Hawley tariffs back in the 30s. They did not turn out very well. There are other periods where we decided that we were going to do this. Um, but what you're telling us, which is very encouraging, is that forget all that crap. Look at the chart. As long as it's above the purple, then we're going to buy the dips. But what are you telling me, or what are you telling your subscribers in terms of, or let me flip it my way. So we have been very long, thank God, gold and silver and precious
Mhm.
metals. I'd love it if you could pull up a gold, like a GDXU or
Yeah,
GLD.
yeah, sure. So I'll actually pull up gold itself because I think we usually recommend, even with a stock that's really closely tied to a commodity, you start with the commodity itself because that's
Yep.
going to be the guiding force behind the trend. And if you look at gold, I mean, across time horizons, the momentum is still there, pretty strong. And it differentiates it, of course, positively from just about everything else. You have
Yeah.
so you have the overbought condition being sustained here. That's a positive. You have a MACD that's pointing up and still growing in its divergence. And this strong uptrend, you have your first sign of upside exhaustion of late in the DeMark indicators, but it's not something you'd react to straight away. It's just something you'd keep an eye on. And then you can zoom in on other timeframes and see pretty much the same. So our recommendation has been with gold, because we can't assign an upside objective using our discipline that's higher than current levels. We've already
Uh-huh.
exceeded our objectives. Our last one was about 3060. So instead, we'll just say, let's keep the momentum on our side. And you can do that, of course, through the MACDs. But I sort of like watching the slope of the 20-day as a tight gauge
Uh-huh.
of the price trend and momentum. And when it starts to roll over, that seems to be a decent time to pare back a little bit, at least.
Well, you're like a
Yeah.
mind reader, young lady, because that's what my next question was going to be. I'm looking at $28 million of managed accounts here, and our gold for this year is up 44%. The silver's up 22%. But the
Mhm.
miners, miners have always dragged. The miners who just never got any action at all. And that's why I like if you throw this GDXU up, That
Yeah,
is
sure.
the miners, because finally miners are getting some respect. They would always sell
Mhm.
at 20% to 40% discount to the actual gold they had in the mines. But finally we're getting some respect here.
It's just the top-down influence of the equity market, in my opinion, that lowers the correlation for the stocks to the
Huh.
commodity. You can run correlations and see it. It's like you lose about 20% correlation. So if somebody really wants to invest in gold, they should go invest in gold. That you can do that via ETFs too, right? But if you
Sure.
want to, if you believe in not just gold, but also the fundamentals of the miners, which I'm quite sure there's opportunity there, then by all means, you go for the miners. And they've had the tailwind just over the past few days of the broader market bouncing off the lows, and then also gold reaching new highs. So that's why they've, I think, just emerged. They're a
Yeah,
little
but let's then
overstretched.
while we're doing this is
Yeah.
fantastic. Let's look at the U.S. dollar, because it's the correlation I use more is the U.S. dollar to at least to the miners in the gold,
I
because
think that's
yeah.
smart. Yeah, you should. So see how it's run up here. This is GDXU, and it has a signal. It's on the verge of a signal from the DeMark indicators here. The last time we got it was here, and you see we got a 2-week pullback. So if
Right.
we get that signal or trigger tomorrow, we would expect a 2-week pullback. And if you take that, we'll just leave up the same chart and look
Hey,
at the
Katie,
dollar.
if you get that, call me, would you?
Yeah.
You have my number.
I think it's likely. So, and then look at the similar chart, the daily bars and the dollar index. We're potentially 2 days away from the countering signal there. So it would make sense to see a dollar rebound over the next couple of weeks as gold and gold miners retreat to some degree. But is it enough to necessarily reduce exposure? Maybe not. Maybe you're perfectly happy living through some kind of short-term pullback there.
Yeah, I would just, again, being Mr. Fundamental here, the obviously we're in Never Never Land. This is chaos 10, chaos we've never seen before. So there's no playbook, if you will, on, well, gosh, if you do this, that. So I'm sort of making up the playbook as we go. I so appreciate what you're talking about. Again, simpleman me, dollar going down in value means that in theory, it should be good for international tech companies because they're selling, now they have some pricing power, right? But so we started sort of legging into some of the software. I'd love you to look at one of your software charts, enterprise software particularly. My theory here has been that regardless, I almost said irregardless, by the way, that's not a word. The If I'm an enterprise and I run my company on, it doesn't matter, but I'm on a Microsoft system, or I'm on Workdays, or I'm on CRM, or whatever. It's not tariffed. I can't stop using it. And if I stopped using it, I'd be, thrown out of my tail if I was a CFO. So they're going to make those monthly payments on that software no matter what. They may, cut headcounts a little bit, but it's you can't run the business without these enterprise platforms. So, and then the other one you can't do business with without is CrowdStrike or any of the platforms for cybersecurity. So I'd love you to show a CrowdStrike as well.
Yeah, yeah. So, you bring up some great points. I think with the dollar move, you have to trust that there's got to be a big lag, and the hard part is knowing what that lag is, right? When does that dollar weakness have a favorable impact on the fundamentals that carries over to the actual stock price, right? So that's we have to fill in the blanks, right?
Hey, wait a minute, you're taking my place now. You're a fundamentalist and chartist. Yeah. Well, of
Yeah,
course, if you have a long-term contract and you are paying in dollars, a lot, these large companies have already hedged it. So there
yeah.
is no benefit. That's why I like about CrowdStrike. They had their little Delta foo bar a while ago. And to me, that was like the greatest buying opportunity of all time.
It
Uh,
sounds to me like there's sort of a more defensive component of software than based on what you're saying. So we do actually do a lot of work for a couple of long short equity PMs focused on software. So we get to know their names very well. And what we've found is that there's a real cyclicality within the group, right? So you can find sources of relative strength. The CrowdStrike is a great example of that. So this is the ratio of CrowdStrike versus the S&P 500. You can
Yeah,
see that,
that was their little Delta Airlines blue right there that went
yeah,
straight
a little
down.
blip there, right? But
Little blip
generally,
there.
it's been a good relative performer, and you can't say that about all the software names that comprise the IGV. You can even see much different setup in a Microsoft. So we feel that within the software sector there are relative opportunities. The catch is that it's not a sector that would tend to be immune to the top-down influences of a bear cycle, right? So even a CrowdStrike, as much as relatively, it's probably better positioned. In absolute terms, the indicators have some of the same issues as they do for the S&P 500. So we have the overbought downturn, kind of
Right.
neutral-ish momentum. So I don't know that it's going to be really additive to a portfolio in a bear cycle, but it probably does better than the average software name.
Well, you brought up my next question, which is because you're the all-knowing, all-seeing Katie Stockton. That bear cycle you are referring to, did we enter it when we went down 24% in the Nasdaq? Was that just a
Yeah.
huge drawdown that now is sort of got breathing again? What do you see?
So I use not like percentage qualifiers, but rather indicators and levels.
Okay.
So this to me is a bearish cyclical bearish shift, right? We don't have, this is a MACD on a monthly chart. So this is on the S&P 500. We have the same on the NASDAQ 100. If this is locked in at the end of this month, since they're monthly indicators, then
Uh-huh.
that to me would be your bearish cycle indication. It would suggest that we've gotten into that, right?
Okay, give me a call out on that one too, would you?
Yeah,
Uh,
no problem. And then this would have been an early indication of that, but not quite as, this could also occur with a trading range environment, but this is usually more of a bear cycle type of indication we found that. And then the other thing, I'll go to the monthly chart that you'd like also, the cloud. So that the shaded area, when we post 2 weekly closes below that, that to us is also affirmation of a bear cycle.
yeah.
You have sort of like metrics that are somewhat specific to us that we feel like provide evidence that this is more than just a correction, and we do have some evidence of that, but it's depends on what you look at.
Well, of course, obviously, we haven't even got into earnings season. I mean, we had a few banks here for crying out loud. Um, it will be amazing to be very. But before I get into that question, what do you consider a bear cycle? Is there a normal length of a bear cycle?
If you go back and look, I would say, thankfully, they're shorter than the bull cycles,
Yeah.
right? I would say it's not often that you see them last more than a year. So we don't have refined metrics around that, but I would say generally speaking, the experience is that they're shorter than a year. So if this is the start of it, I mean, we have a sort of a clean setup that this started basically this year in February, although there were indications of it towards year end.
Yeah.
So most of the indicators that we use point to this bearish cycle being done towards the end of the year. So
Well,
lasting
after
much
this interview,
longer.
I'm signing up for all of your stuff. I
Oh,
get your
that's great,
weekly.
Tony.
Uh, but we went, that's why we started loading up on gold and silver, et cetera, in February, because our simplistic system over here was saying that we had lost momentum, number one. Number two, again, because algorithmic momentum trading was such a big part of that swoosh up,
Yeah.
that live by the sword, die by the sword, right? So when we got all of a sudden there was more momentum on the shorts than there was on the longs. That sort of said that, because again, I mean, if you go back in the history, this is another reason why to me it's sometimes hard to compare time frames. When I started, the first this was 1982. We traded about as many shares of shares on the New York Stock Exchange as we did this morning after 18 minutes. Um, I mean, it was such a different. There was no algorithmic trading. There was
No.
very little options, if any, and the options were only really futures. Yada yada yada. And so now you have the Jim Simon renaissances of the world that introduced this whole momentum dealio. And it's awesome when it goes up, but when it breaks, it is a self-reinforcing negative feedback loop, right? And so that's, to me, what I call a bear cycle is that selling begets selling.
Mhm.
That the weak hands have to sell. The people are scared. Yada yada yada. And then we reach the puke point, which is my next question for you. Where do you think the puke point is of this cycle?
Yeah, and so you're right. I do think the moves get exacerbated by all of these forces that you highlight. I think even like the new products that have come
Oh
to
yeah.
market, ETFs even can exacerbate moves, and that's why
One day
you can.
options? No one ever
Yeah.
dreamed of a one day option in
No, I know. It's pretty
1982.
wild, isn't it? And I don't know how to measure that, but you can certainly see it in the chart. The
Yeah.
indicators are still helpful, right? Because they're by design, they're eliminating what is supposedly noise, right?
Noise.
They're
Yeah.
still very valid. But when you see the volatility pick up, it doesn't tend to be a good thing for the markets, as we know. So, and relief rallies in bear cycles are the most violent, right? So
Yeah.
the best
Well, again, I
updates
was
are
looking at
in.
this number here that the U.S. stock market, when it goes through that melt up, is higher 6 months later, just 43% of the time. And that's going back to 1928.
Mm.
Um, that's lower than the 67% probability S&P will advance in a year. So, yeah. So, what are you telling your clients in terms? Where are the safe spots other than my gold, silver, and and money market accounts?
Yeah, so there's not much that has positive momentum. We actually just recently looked for sources of positive momentum from like a global macro perspective. We looked at everything, right? And you
Yeah.
just can't really find it outside of the precious metals complex. Some of the, if you look at the monthly indicators of momentum, you can see it still in China. You can see it in natural gas, still in copper prices. So there
Yeah.
are, some that still have that long-term tailwind, but the retests in those areas have been and can be pretty violent. So it doesn't necessarily feel like the best entry points there. So it truly is somewhat limited. Gold, obviously, silver to a lesser degree. We had a bit of a shake out, I think, in silver that was somewhat concerning. And then the treasury market, which is more neutral in the way it's setting up right now, does have that potential for relative performance and safety still.
All
Uh,
right. Now you just I mean, I don't know. We should this is a show we should do every day because you're thinking what I'm thinking at the same time. It's a
Good. I
mind
like that.
meld.
I like that. And
um,
the short-term treasuries have done quite well, as you
yeah.
can imagine, and certainly a fine place to hide, or to have. You could think of it more as you want to have liquid, sort of money to put back to work when the market's warranting it. And we don't know where that's going to happen, of course, but what we at least like to see is improvement in the long-term gauges, right? So we have just pretty new downturns to suggest it's going to take time.
Hey, so we use the 2 year and we use a couple other, essentially $0 type of yields, the 4 or 5% guys. Is there a favorite one you have in the T bond to where you get some upside as if interest rates in fact do come down? Because that's the other thing I'm so confused about. We're supposed to have a rush to safety, which makes bond prices go higher, which makes yields go lower. Right now, our yields are higher and our bond prices are falling.
I know there's some dueling
It's like
influences out there.
it's as I say, there's no playbook, but the playbook changes every day.
So we have an ETF, and in the ETF we do buy short-term treasuries via
Yep.
another ETF. And that ETF is this SPTS. It's an equivalent to like an SHY, like a 1 to 3 year treasury ETF. And you can see why it's more attractive right now
Yeah.
than a lot of things, right? Just look at the long-term indicators and look at the year-to-date action. And it's yielding about 4 to 4.2%, which is fine. It's not going to, be anything to write home about, but it does provide safety and some yield in an environment that maybe there's a little less safety. So we diversify though that risk off exposure between gold, short-term treasuries, and then also long-term treasuries.
Yeah,
So
for the Schwab investors out there, you have the SWWXS that is a solid $1 price. I mean, Schwab basically supports it. And you know, we were 40% in that a while ago. And
And
again, go
you
ahead.
should feel fine about that. I mean, in terms of just risk management, there's so many different ways to go about it, but carrying heavier cash balances, I think, is a perfectly good way to, miss some of the downside, set yourself at a higher, place from which you need to recover. And, I don't think you should ever take your equity exposure down to zero as an advisor. You need to have that growth potential, and you need to avoid probably all of the taxable events that would incur. But that cash balance can be handy, once we get to a place where there's more evidence of a long-term low.
Yeah, I mean, again, the context, at least for us, is that I was at that OpenAI discovery meeting in November when we discovered that they had this thing called generative AI. I thought it was a disease. I didn't know. Um, and and then it became clear that in order to make it happen, it was going to be what I call the AI data center chip stack, and obviously on the top of that was NVIDIA. So bottom line, with $1 million in an account, that account was now $3.4 million after that time. So if that was $10,000, that's $34,000. It doesn't matter. But when you have those type of gains, that also changes your strategy. You've earned 80 years of returns or more. I mean, more than that, actually, in 2.5 years. So now your strategy is to protect that and not assume you're going to get that. So for people who are like my subscribers and clients who are sitting on a boatload of cash, or excuse me, a boatload of profits, we have been taking those profits in January, February. But the safe places you like to be again are, besides the SPTS?
I think that's a perfectly good strategy, because you have to take the downside volatility in the context of where we've come from, and it's been explosive. And if you've ridden that trend, and especially if you've outperformed the S&P, which the passive investing really was rewarded over the past couple of years, then by all means, to lock in some profits should be.
Yeah, especially again with capital gains, and God, we have these new asset trusts. You can put $1 million into a ADSL asset trust, and then you borrow that money and you can invest it, and you get to deduct the interest. I mean, my Lord, there's a reason why the rich get richer, Katie.
Yeah.
I mean,
But I would say gold, we like strategies, like active strategies that use asset allocation but are systematic, like our ETF TACK, TACK, excuse me. We also like short-term treasuries, long-term treasuries, maybe a slightly smaller position. Some in terms of going to international equity markets, we we would be somewhat selective, because the emerging markets are often tied to the commodities, right?
sure.
And, some of the agricultural commodities look pretty interesting. So if someone out there knows that there's a country index or something that can leverage that, that might be an interesting trade. You had mentioned in your notes, Mexico. The Mexico trend looks pretty compelling. It looks like it's already longer term oversold. I can't pretend to know the impact of tariffs there, but there's ways to manage risk, right? Just make sure you know what you're putting out there. So there might be some country opportunities, but I would be treading somewhat cautiously. Europe has been such a source of outperformance year to date, and we actually think it is the start of something meaningful. But I don't know that right now is the best entry point there. I think we need to let it work itself out a bit more and get more oversold in absolute terms.
Yeah. I know when I go back to like my mutual fund days or hedge fund days, when you're sitting and looking at the 25 different screens and everything's red, yada, 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 the thing that looks green is like the life preserver. And European stocks, particularly European defense stocks, after all the malarkey there. So we've been long the European defense stocks. I mean, again, they're all cheap. Europe stocks, as you know better than anybody, haven't worked for, I don't know, the last 5 years, 10 years. But it was a sea of green, or it was a an island of green and an ocean of red.
Yeah.
And so the European defense stocks, the German DAX because of the stimulation they're doing, and then we did go along Alibaba and JD in China just because of the $1 trillion stimulus, the fact that that they were allowing margin rates to come down to basically zero to pump up the check. So I'd love to look at any of the China ETFs that you follow.
Yeah, for sure. And China would be one that has that long-term momentum tailwind, but it's just not a convincing entry point from our perspective. This is the FXI ETF, and this one has, excuse me, I have a little sinus thing going on, stair-stepping higher.
It's okay to blow your nose on my show,
Just
okay?
piles it on, right?
Yeah.
So the corrective phase has taken it into some support. But with that, we have downturns in the long-term metrics to suggest that it'll stay out of favor for a little while. So we'd love to see, this correction maybe resume and then discover some support around our trusty cloud here for an entry in what we think is a long-term basing phase. So we're compelled by that. And we are compelled by that relative performance shift versus US for all of these global equity markets.
Cool.
But we would be, selective, not to get too cliche, but sort of selective in terms of the country exposures, and wait for high conviction entries, at least on a short-term basis, before taking positions.
All right.
Yeah, but as mentioned, agricultural commodities, if somebody, we don't have any fundamental or macro views there, but as something that looks a bit different, right? You could say that the ags look quite different. This is an agricultural ETF called DBA. You see that uptrend still has momentum.
Well,
It's not immune to what a corrective phase has done to the rest of the market. But when you pull up the individual commodities, I think there's some potential there for
cool.
at least stabilization. I'll show you on the price.
All right. Well, Katie, we got to get rolling. It's been so great that I'm getting the rap signal from the producer, and I'm not talking about the music. Okay.
I could go on and on.
Well, look at, we're gonna, you're gonna be a staple on this show because it's just so beneficial, so helpful. People are, upset, they're scared, and I'm a little more proactive in terms of, yes, we're long-term investors, but we also, are and take the idea that if your NVIDIA cost basis was $26 or $18 as it was for us in May of 2023, pigs get slaughtered, right? And so we've had a lot of capital gains. That's okay. After tax, you're still, better than 99% of people out there. But if you follow Katie, and Katie, tell me again where people can follow you and what your ETF is. Is that the TACK?
So TACK. So TACK. They can find information certainly on our website, fairleadstrategies.com, and they can fill out just a contact form there if they want a free trial of our research, which I would encourage just to see the methodology in action. And more information about all of our sort of research and products is on the website. And we do have a Twitter account and a LinkedIn and what have you. So I encourage everybody to search us out there.
Well, you are a jewel, and you're like the life preserver in the middle of the freaking red here. So I appreciate your time. We'll have you back always. And
good to be with you.
David, I was like, namaste. Everybody,
there you go. Okay.
Take deep breaths.
Breathe a sigh of relief. Yes.
All right. Cheers. Thanks so much for being with us.
Yep.